The chair recognizes the gentleman from Connecticut, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman. Move to strike the last word. We deal with few topics as complicated as derivatives and swaps in this committee, and I just want to offer a couple of clarifying thoughts on this. A lot of the concern that was expressed, certainly on this side of the aisle, I think was driven by an article that was in the New York Times talking about transparency in this market. And I think it's really important that we start recognizing that one of the signal achievements of the Dodd-Frank legislation was that it dragged an otherwise opaque market in which there was no requirement to report trades, in which there was no effective oversight by any regulator of that market into the open. So as a result of Dodd-Frank, every swaps trade, whether it's conducted bilaterally or through an exchange or however, it will be reported to a repository, and the regulators will know about it. Moreover, as a result of Dodd-Frank, the regulators have specific powers to impose margin requirements on swaps, and broad powers if we were to see an AIG developing again. And really, at the end of the day, what we're talking about when we talk about derivatives is the disaster that was AIG, to actually require that they either change their practices or even to get out of the business altogether. That's a huge achievement. The things we're talking about today, and which this legislation touches on, is something a little different. It's how things trade. And the fact is that things trade very differently. If I'm buying a gallon of milk, that's a very different arrangement than if I'm buying a house. And swaps run the gamut between milk and house. There are some that are very liquid, that trade openly, where everybody sees the prices, and then there are very specific tailored swaps. A corporation wants to go out there and hedge yen risk over some odd period of time in some odd amount. There's just no market for that. It trades by appointment. We're here because the CFTC has proposed some regulations that are highly proscriptive on how all swaps trade. You got to go out there and find 5 bidders. What if I told you that when you were selling your house, you got to find 5 bidders? Doesn't necessarily make sense. I think the ranking member is probably right that we are going to see some convergence between the SEC and the CFTC position. But it's really important that we don't forget that as a result of Dodd-Frank, these will be transparent markets. We will know as a regulator or as a series of regulators what happened. So what we're really talking about is how proscriptive do we want to be on trading. Now there's no question that when you don't have an open and active market, there is an opportunity for a wide spread for somebody to make a lot of money. Now, if I had the time, it'd be interesting to think about how much does Congress want to get involved in that question. I don't think we get involved in asking, you know, what the profitability of an auto dealer selling a car may be. I'm pretty sure we don't get involved in the question of how do we feel about 6% real estate agent fees or 7.5% gross spreads for investment bank. These are all profit going to the agent or the bid-ask spread, and we're not involved in that, and I think that's probably appropriate. I think Mr. Watt is right. We should encourage more transparent markets, but from our standpoint, reporting to a repository and giving the broad powers that were given to the regulators to monitor and impose change on those who engage in swaps is I think, what we need to do. I hope that the CFTC and the SEC converge, but we need to be very careful about being too prescriptive on how these things trade. Why? Because if you're a corporation that has to do one of these highly tailored hedges, and we impose rules that take liquidity out of that market or impose too much burden on that market, they may not enter into that hedge. And that would be a shame, because presumably they want to hedge some risk. So I will look forward to the ranking member's amendment on this, but I think it's really important that we remember that we've achieved much of what we sought to achieve in the swaps market and the derivatives market, and that we're reacting to what feels like an over-prescriptive set of proposals here. Last point, people on this committee will remember that I raised many objections to some of the crowdsourcing ideas that we dealt with, because of course crowdsourcing would have gone to the moms and pops, the widows and orphans, the retail investors. I defy anyone in this room to find participants in these markets, the highly complicated swap markets, CDSs, that are mom and pop investors. This is Citibank on one side, J.P. Morgan Chase on the other. J.P. Morgan Chase on one side and a hedge fund on the other.
The gentleman yield on that point.
I think I'm out of time, but I'll conclude.
I ask unanimous consent the gentleman have an additional 2 minutes because I want to hear the rest of what he says.
Sure,
but
and I'm wrapping up. I just want to make the point that in the swaps and derivatives markets, we are not dealing with mom and pop retail investors, and we should bear that in mind as we continue this. And I'm happy to yield to the.
I thank the gentleman for yielding.